Welcome to Candid Conversations for Financial Markets podcast series. I'm your host, Laura Paglia, President and CEO. Our podcasts are designed to provide insights, transparency, and provocative yet achievable proposals for matters that move financial markets in Canada. We're discussing tokenization as a reconfiguration of specific parts of the capital markets value chain, from issuance to post-trade. The key questions as to where it actually changes economics, market structure, or risk, and where it doesn't, where the frictions, skepticisms, and opportunities lie. Welcome, Duane.
Thank you, Laura, for having me.
Let's start with a deceptively simple question. When we say tokenized equity, what exactly does that token represent?
Tokenized equity can mean several very different things, and the distinction is foundational. A token could represent actual registered equity of the issuer. This confers the same rights as traditional shares if it's the same class and reflected in the issuer's official records. This is often referred to as an issuer sponsored token. The token could represent a security entitlement or a beneficial interest in the shares held through a securities intermediary. This is referred to as a tokenized entitlement. Or the token could be a third party contractual wrapper tracking the price without conferring shareholder rights. The question then is, what legal claim does the token carry for voting, for dividends, for corporate actions? Each of these representations may be called tokenized equity, but they differ in terms of the rights and the counterparties involved.
Would any of the tokenized versions that you've described have the same CUSIP number as a stock, or
Depends
is
on
it
the
considered a
structure.
separate instrument? Sorry.
It depends on the structure. The tokenized version is legally the same security as the conventional share if it has the same rights and obligations. There, we would expect the same CUSIP. If the tokenized version has different rights, a different issuer, different transfer restrictions, or is a different class, we would expect it to be a separate instrument and not have the same CUSIP.
Thank you. And stocks and bonds. Does the same tokenized model apply to bonds as they do to stocks, or are they different?
The same broad models apply: natively issued tokens, tokenized entitlements, and wrappers. However, bonds are more lifecycle heavy than equities. A share represents residual ownership and governance rights. A bond is a contractually defined payment instrument. Tokenizing not only ownership rights, but also the instrument's contractual lifecycle is a key aspect with the bonds. This is why fixed income may be one of the richest tokenization use cases. Bonds are programmable financial contracts already. Tokenization has the potential to impact each event in its lifecycle.
When it comes down to issuance, whether for stocks or for bonds, does the tokenization process make it easier for companies to raise money?
It can, but tokenization doesn't create investor demand by itself. A weak issuer is still a weak issuer, and a poor credit is still a poor credit. What tokenization can do is reduce friction around investor access, onboarding, documentation, settlement, ownership records. The early opportunity might be in private placements or structured notes, private credit. Tokenization doesn't make capital formation effortless. It can make it more targeted, more modular, and more data rich.
So it's changing the costs and the economics of it.
Yes, but the timing matters. Early tokenized issuance may actually cost more. The issuer needs legal work, technology vendors, custodians, smart contract review, but over time, those economics could improve. If tokenization standardizes repeatable functions, onboarding, allocation, settlement, then we have the opportunity to see costs come down over time. For shares, that savings might appear in shareholder records, voting, dividends, corporate actions. For bonds, that savings could appear in coupon payments, consent solicitations, reporting, and redemptions. The cost case is strongest where the old process is manual, fragmented, and expensive.
So which parts of the issuance process stand to benefit most from tokenization?
The biggest benefits are in the repetitive operational parts. So that could be investor onboarding, eligibility checks, allocation, settlement, transfer restrictions. Underwriting doesn't disappear because the bonds still need pricing, due diligence, distribution, balance sheet, and credibility. But the underwriter's role does change. It becomes less about manually coordinating fragmented workflows and more about orchestrating a digital issuance. Ownership registration and operational record keeping may also evolve. Tokenization doesn't remove the need for trust, it changes where the trust is embedded from the documents, manual review, and reconciliation into controlled digital workflows.
So, would it be an overstatement to say that tokenization can enable continuous or on demand capital raising?
It can, especially in private markets and programmatic issuance, but tokenization by itself doesn't create a legal right to raise capital continuously. Tokenization can make securities more modular, smaller denominations, repeatable documentation, pre cleared investors. That opens the door to rolling offerings, but continuous issuance still requires disclosure, governance, investor protection, and market integrity. Issuers can't raise money from anyone at any time simply because a token exists.
So, moving to connecting those issuers with investors, is tokenization allowing issuers to connect more directly with those investors?
Direct connection doesn't mean eliminating every intermediary. In public markets, issuers still need some combination of dealers, custodians, transfer agents, depositories, exchanges, and regulated platforms. But for equities, that can improve shareholder communications, voting, dividends. For bonds, it can improve coupon payments rather, and consent solicitations. The issuer investor relationship becomes more continuous, especially where the tokenized ledger is integrated with the issuer's official register or transfer agent records.
So, taking into account that we still need forms of intermediation, does tokenization blur any lines between who's creating the product and who's distributing the product?
It certainly can. Tokenization can blur the line between issuers, platforms, custodians, transfer agents, brokers, dealers, and exchanges. A platform that tokenizes exposure to a stock or bond may not be merely distributing an existing security. It might be creating a new product with separate legal, custody, and counterparty risks. Issuer sponsored tokenization can preserve shareholder or bondholder rights from the start. Third party tokenization may provide economic exposure without full rights. Tokenization does not erase the difference between creating a product and distributing one, but it can make that difference harder for the market to see.
When we look at the full picture, which intermediaries in the distribution process become less important with tokenization and which become more important?
Intermediaries that exist mainly because records are fragmented or processes are manual become less important. Intermediaries that provide trust, compliance, liquidity, custody, and legal services are likely to become more important. For example, dealers could become digital distribution orchestrators. Custodians could become wallet administrators and entitlement processors. They will have a larger role in private key control. Transfer agents could become digital registry operators. Marketplaces could become gatekeepers for whether a tokenized instrument is admitted for trading. So, in sum, regulated dealers, custodians, transfer agents, and marketplaces remain central, but some responsibilities and services might become battleground territories where tokenization compresses some functions while it elevates others.
Thank you, Duane. Taking all of that into account, let's move to the secondary market. We have securities that are issued and distributed. We see a lot of attention around tokenization being given to concepts of trading and liquidity. So, starting with how does tokenization affect the role of a trade desk?
Tokenization changes the role for trade desks because the desk still makes prices, but now it must also answer what exactly is the token? And is the token the same legal share or is it a different instrument? It needs to know the product well enough to satisfy KYP or know your product obligations, suitability. So it really does come down to understanding because there may be a different security involved.
Does that process ultimately improve secondary market liquidity?
It can, but liquidity is not created by tokenization alone. Liquidity comes from buyers, sellers, market makers, and others only when there's confidence in settlement, proper price discovery, and tokenization can help reduce friction by enabling fractional ownership, expanding distribution, improving transparency. But it really does come down to having to be the same legal instrument. If it's not the same legal instrument, it can actually fragment liquidity.
So look at the trading, um, if we look at trading and liquidity, what does tokenization do, if anything, to starting with market making?
Market making becomes more complex. Market makers must price not only the security, but also the legal form of the token, custody risk, settlement risk, transferability. If the tokenized instrument is the same legal security as the conventional security, the issue is less about pricing a wrapper.
And price discovery?
Price discovery may improve if tokenization creates more transparent real time data, but it might worsen if liquidity fragments. And liquidity could fragment if, in fact, it is a separate underlying security.
Therefore, we see impacts on best execution.
Well, a lower displayed price may not be better execution in this context if the client is actually receiving a different legal claim. If it receives weaker liquidity, different corporate action treatment, higher custody risk associated with the token, then the desk is recognizing here that it's a separate legal instrument and the better execution isn't necessarily driven by a lower displayed price alone.
Duane, thank you. Do you see new trading venues emerging that would be competing with what we now see as traditional exchanges and ATSs?
Yes, but credible tokenized security venues will look more like regulated market infrastructure than open crypto platforms. They will need identity, permissioning, surveillance, and custody. New venues would need to fit within applicable regulatory frameworks. And if public securities are involved, the venue may also need to connect with existing clearing, settlement, custody, entitlement, and depository infrastructure. So, a tokenized security venue is unlikely to be a technology platform in isolation. It will likely need to integrate into the market infrastructure as an exchange, an ATS, a registered dealer platform, a recognized marketplace, or other regulated structure.
In the interim, is the greater likelihood that tokenized markets um, help markets operate 24/7?
Well, the blockchain can operate 24/7, but the markets still need various intermediated activities. If something happens at 2 a.m., what benchmark rate would be used to price a security? Is there sufficient liquidity? Are there sufficient quotes? So the fact that the technology can operate 24/7 doesn't mean that a intermediated market can automatically operate 24/7 at the same time.
Thank you. Going into certain aspects of the secondary market, um, starting with securities lending. Does tokenization have an impact there?
Yes, securities lending may be one of the underappreciated areas. If a tokenized share or bond is fungible with the conventional security, it could become easier to move, to finance, to recall, and to track as collateral. If the token is a synthetic wrapper, it may not be lendable or deliverable into the traditional equities lending chain. The wrapper might be financeable as its own product. Tokenization can make securities lending faster and more transparent, but only if the token is recognized by the legal, custody, collateral, and settlement architecture that securities lending depends on.
Short selling?
It can impact short selling, but the biggest impact on traditional short selling comes only if that tokenized security is fungible and financeable. Short selling depends on borrow availability, a reasonable expectation to settle, settlement margin, recalls, and deliverability. A tokenized share is the same legal security as the conventional share. Well, that could improve transparency around borrows, recalls, and settlement. If it's not the same security, shorting the token may not hedge or settle against conventional shares cleanly. That would create basis risk and regulatory complexity. A short position in a tokenized wrapper may be a short of the wrapper, not a deliverable short sale of the underlying share.
Thank you, Duane. Um, the repo and collateral markets have certain frictions. What are they? And does tokenization reduce them?
The traditional repo can be heavily dependent on relationships. There are search frictions and price dispersion. There's also some power dynamics involved with some of the intermediaries and participants. And if we think about tokenization, yes, there could be some reduction in friction, especially in fixed income. Bonds are not only investments, they're collateral. We could see that collateral move faster between margin accounts and repo counterparties, custodians, and clearing systems if they're legally recognized, operationally accepted, and eligible to serve as collateral.
Thank you, Duane. I'm going to move to certain distinct phases of the post-trade life cycle, and starting with settlement, clearing, and custody. Um, how does tokenization, in a nutshell, impact the traditional clearing and settlement system?
Tokenization has the potential to streamline clearing and settlement, but it doesn't replace them. Traditional infrastructure does solve hard problems: finality, netting, risk management. Tokenization can reduce reconciliation, accelerate settlement, and even enable atomic delivery versus payment. But if every trade settles instantly in gross, firms are likely to need more pre-funded cash and securities. That can increase liquidity demands even as it reduces counterparty risk.
Thank you, Duane. Tokenization often focuses on the security leg, the tokenized bond or share. But what does the leg need to look like for tokenization to support true delivery versus payment and settlement finality?
The cash leg needs to be institutional grade settlement money, not just a convenient digital wrapper. It needs to be legally clear, redeemable at par, operationally resilient, available within when the market needs it, and acceptable to regulated dealers, custodians, clearing agents, and investors. The strongest form would be central bank money, tokenized commercial bank money, or highly regulated fiat backed stablecoins.
When a security is tokenized, who controls the ledger of record? What kind of governance do you need around that ledger for settlement so that the resulting positions are reliable?
Well, this is really a market structure question hiding in plain sight of a technology conversation because permissionless ledgers do have advantages. There's broad distribution, open connectivity, transparency, transparent audit trails, but tokenized securities aren't bearer assets. The market does need to know who the investor is. Therefore, if a tokenized security contemplates a permissionless ledger, it needs controlled securities layer, whether that's whitelist wallets, transfer restrictions, regulated custodians. Privacy is the other hard issue when you think about a permissionless ledger. Institutional investors do not want their positions, their trading flows, collateral movements, trading exposed to the market. A third model is emerging where new financial market infrastructure folks are building the ledgers to solve some of these issues. And the ledger of record is valuable real estate in capital markets. Whoever governs that ledger has a critical role in settlement finality, investor rights, liquidity, data access, and the economics of intermediation.
When we take all of this into account, is tokenization reducing the need for custodians or just changing their role?
Well, it is changing their role. Tokenization may make custodians more important, not less. Someone still has to safeguard assets and segregate client property, process dividends and coupons. Tokenization expands the role by adding the management of private keys, wallet permissions that control the movement of tokenized assets. Self custody may appeal to the crypto native user, but tokenized securities are really regulated instruments. When we think about the custodian of the future, it's not just a vault, it's a wallet administrator, an entitlement processor, smart contract control point, and compliance node.
So once an investor owns an asset, there's also a range of administrative functions that have to take place. Um, how might tokenization change the way shareholders are recorded or management is ownership is managed?
Tokenization could make shareholder records more real time, transparent, and rights aware. Today, issuers see an intermediated ownership chain rather than a clean view of beneficial owners. That often means the issuer's register may show an intermediary, while the ultimate investor sits behind dealers, custodians, and beneficial owner processes. Tokenization could connect the issuer register, the transfer agent, the custodian, and the investor platform more directly. But design matters. If the token is the share, the ledger may be part of the legal record. If the token is a wrapper, the true shareholder record may still sit elsewhere.
Thank you, Duane. With respect to bonds, um, coupon payments, principal payments, and reporting requirements, what does tokenization do?
Fixed income may be where the servicing gains are the clearest. A bond is often a long dated stream of obligations, coupons, principal calls, puts, tenders, covenants. Tokenization could make those events more automated, more auditable. But legal documents will still matter. Code can't replace the indenture, the trustee discretion, and the insolvency law or regulatory reporting. The first wins might be in private credit, structured notes, and institutional bonds, where the investor base is more controlled, documentation is more bespoke, and the lifecycle data can be designed into the instrument from the start.
And finally, general investor interaction, whether it's voting, paying, corporate events, how does tokenization help?
Tokenization could move issuers from periodic, intermediary mediated communication toward a more direct and event driven interaction. For equities, voting could be tied to the verified ownership at the record date. Dividends could be paid more efficiently, and rights and offerings and tender offers could be processed through digital elections. For bonds, issuers could conduct consent solicitations, covenant reporting, and tender offers through permissioned digital workflows. Tokenization turns investor servicing from back office plumbing into part of the product experience for tokens that represent the security itself.
Thank you. Um, there has been questions arising regarding broader impacts on market structure and whether the items that you've described represent an incremental approach to modern markets or that we're seeing something much more fundamental take place. Starting with private markets, whether it's equity or credit, do you see them adopting tokenization more quickly than publicly traded securities?
And private markets are more likely to adopt first, while public networks are likely to matter more once adoption scales. Private markets have more pain points: manual subscriptions, transfer restrictions, illiquidity, fragmented records, capital calls. Tokenization can address those issues without immediately disrupting national market systems. Public markets can be more complicated due to integration and other requirements related to exchanges, depositories, transfer agents, and best execution.
Thank you, Dwayne. If we are we saying that tokenization ultimately changes who issues, trades, and holds financial assets?
Tokenization offers easier issuance, but understanding who that legal issuer is still very much matters. And it comes down to a question of, is it issuing the true share, the true entitlement, or is it issuing a new security?
Where would you put tokenization? The question is, are we evolutionary or revolutionary with what we're saying?
Tokenization is evolutionary in its implementation from the beginning, but it's potentially revolutionary at its destination. In the near term, it really does start as an upgrade to market plumbing: better records, faster settlement, automated servicing. The path will likely be cautious, permissioned, regulator engaged. But the endpoint is revolutionary when we have the true security token with 24/7 liquidity where the token is the legal instrument.
Duane, thank you very much. An incredibly informative discussion. Thank you.
Thank you for having me.